You are listening to Keystone Stock Talk Show, episode 233.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a busy show planned for you this week as we prepare for our final DIY stock investing webinar of 2023 this Thursday. Do not miss out on this event. We have 4 Your Stock Our Takes for you this week. Aaron begins by answering a question on Restaurant Brands International, symbol QSR, on the TSX, which reported Q3 numbers that missed estimates on slower Burger King growth. Clearly, Brennan needs to get out there and consume several Whoppers this week. Get on it, Brennan. Aaron will let you know if QSR is an opportunity or a stock to be wary about on the lower growth. I will answer a listener question on Canadian legal software company Dye Durham, symbol DND on the TSX, a company which we have taken a pass on this show at $50, $40, $30, $20, and with the stock now cut in half once again to $10, a listener asks us if DND is finally a buy. Additionally, in our Your Stock Our Take segment, Brett answers a viewer question on Transcontinental Limited, symbol TCL.A on the TSX, a leader in flexible packaging in the US, Canada, Latin America, as well as Canada's largest printer for items like books, magazines, and newspapers, among other printed items. Brett takes a look at the company, which pays a strong 8.2% dividend, but has had limited growth at present. Last and certainly least, Brennan answers a viewer question on leading uranium producer Cameco Corporation, symbol CCO on the TSX. Brennan lets you know whether the strong year-to-date run in the stock can continue. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing? Good weekend? Good. Did you enjoy our seminars last week?
Yeah, sure did.
We did 2 of them.
Enjoy them.
Did you enjoy them? Did you enjoy
it? But I was there actually doing the
stage.
Seminar, so it's a little different. But I hope that the people watching enjoyed them. We've got
I think there was
one of the things
content.
we do is we have a widget on the keystocks.com website where you can go and you can book a 10-minute call with the analyst. So we did get several calls since the webinar happened last week from people that were attending and also from some people that couldn't attend. But
so tickets are available to the final one, like I said, this year, November 9th, 7 p.m. Eastern, 4 p.m. Pacific. You can get those at www.keystocks.com. We got 7 to 8 profitable stocks you can buy today that are in that webinar, how 2 to 3 great stocks can change your portfolio. We're talking about companies like Hammond Power, Boyd. We'll talk about those. We'll talk about our electrification report. How big bank returns are killing your portfolio, how to build that simple 15 to 25 stock portfolio. Aaron's doing a section on Canadian's roadmap to U.S. investing opportunities there. And I'll give you 5 simple steps to review any stock in 5 minutes. We'll also do about a 20-minute Q&A at the end, so answer any and all your questions. Tickets on our last one are selling out quickly, so we encourage you. We had a sold out first session. We had a VIP session on the weekend as well, but encourage you to get in for our last segment of the year. All right, let's get to the show.
Can I say something actually first?
No. Yes.
Please and thank you. So last week, when we were actually doing our first recording, my favorite hockey team, the Vancouver Canucks, got another W. And this poor kid, my first Sharks game, had to see his Sharks get destroyed.
Nothing on the first game.
Yeah.
It was actually ended up 10-1. It ended up 10-1 too.
It did. And
even worse.
Well, he's become a meme. Yeah. Poor kid. But
kid.
That is an ugly game. The thing is, the Sharks lost, I think, 10-2 the next night too.
But since that kid has become a meme, the Sharks need to do something about that. Like, they need to invite that kid for a practice and let him meet all the players. You got to do something for that kid now.
Let's be honest, it's a punishment to go to the next Sharks game.
And they completely blow it. So, like, they owe him as far as I'm concerned.
It's actually a punishment. I'd invite him or pay him to stay away from the games because it's not his fault, but it's just torture going to the games. I mean, they are in full-on tank mode this year, so it's by design, but it is. I don't think it's happened.
Maybe they need a little positive PR then.
Yeah, 10 goals giving up back-to-back. And the Canucks, honestly, my Vancouver
Well, I mean,
Canucks,
it was against the top team in the league.
Mine too. They're mine as well.
At least it's
as soon as the Canucks lose 5 in a row, Brennan's off.
No, and I also have this meme to show as well.
What, your car again?
This is a sad but true. My Oilers. Because I was joking. I was waiting for Ryan to call me out on being a Canucks fan. You know, I'm a fair weather fan. You know, next, whatever team is doing well, you know, I'm going to just jump on the bandwagon. But the Canucks are a wagon this year, so you know they're passing the Oilers
for 11 games.
Let's
put it in perspective.
Anyways,
we
wanted to bring that up. I thought it was kind of common.
They haven't scored. They haven't scored 10 goals in a game since the 1990s. So you know it's an achievement. But like we say in this business, it's a small sample size. Let's let it continue a little farther,
of course,
and see if we can have a larger sample size.
Attitude there, son.
Yeah, that's true. That's what we do when we look at a stock. It's been going up for 2 days. Get in. It's had good earnings for 1 quarter out of 27. Get in. Anyways, all right, let's move to the companies. Or is there anything else we want to talk about that's going on in the markets? I think we got 4 Your Stock Our Takes this week, so maybe we just want to dig into it. So we're not here till next Thursday. All right. Aaron, you're going to talk about... I think it's in the agenda that you're in there. Read the damn notes. I'm just kidding.
Let's do it.
No, get in there. Get into it. Do you got slides to share? Get them up.
I do have a few, yes. So
you're going to talk about QSR. And
we're talking about restaurant brands. That's right. So symbol QSR. It trades on the TSX, also trades on the New York Stock Exchange in US dollars, but I'm going to just cover the TSX Canadian Exchange stats here. So in Canadian dollars, trades at $90 per share. It's a 28 billion market cap company. It also pays a nice yield of 3.3%. So of course, this is a company that we follow fairly closely in our Canadian income research. In fact, when we did our 2023 Canadian Dividend All-Star Report, Restaurant Brands was one of the companies in the top tier monitor list. So we're quite familiar with them. They are a global quick service restaurant company. So fast food. They own 4 fast food brands, including Tim Hortons, Burger King, Popeyes, Louisiana Chicken, and Firehouse Subs, which is the most recent addition. But they are a huge company in the quick service space, one of the biggest in the world. Over 28,000 restaurants in 100 countries. So I just kind of realized as I was putting these slides together that last week I covered the largest restaurant company in the world, which is McDonald's. Now I'm covering one of the I would imagine probably top 5. But anyways, let's take a look at recent performance of this company. So over the past 5 years, you know, stock hasn't really gone anywhere. Quite a bit of volatility, of course. You know, more recently over the last 12 months, there's been a lot of volatility as well. A little bit of share price return over the last 12 months, but it's taken a bit of a dive since the summer. And this is typical with a lot of stocks. There's just been quite a bit of volatility since this time. But as I said, Q3 results were just released. So we're going to take a look at those as well as a few other items with QSR and just see what type of investment it looks like over the long term and in the near term. So looking at the Q3 results, just the top line numbers, total consolidated revenue was 1.8 billion. That was an increase of 6.4%. Adjusted EBITDA up 8.7% to 698 million. These are all US dollars. And earnings per share of about 90 cents. And that was actually down 6.3%. So the first thing that you want to look at is you saw higher revenue, you saw higher adjusted EBITDA. Why are we seeing lower earnings per share? Well, a couple reasons for that. Higher tax expense, moderately higher interest expense. Not a huge jump in that number, but still enough that it impacted the very bottom line and soaked up a lot of that adjusted EBITDA. So really, when you're looking at a company like QSR, you have to do this brand by brand. And as I said, Burger King, Tim Hortons, Popeyes, Firehouse Subs, these are the main brands. So looking at the number of restaurants in the pool here, Burger King is definitely a top spot, 19,000 restaurants, and they've increased that number by 2.4% over the last year. Tim Hortons, 5,700 restaurants, up 5.5%. Popeyes, up 11% to 4,300 restaurants. And then the most recent addition, Firehouse Subs, that's the little guy in the portfolio, and that's 1,266 restaurants, up 2.6% year over year. And then in terms of revenue, again, Burger King significantly dominating the others, more than 50% of total revenue. In fact, close to 70% of total revenue. So, when you look at this company as a diversified restaurant business, you really have to consider that concentration into Burger King. But their revenues quarterly were up 10%. Tim Hortons revenues up almost 10%. Popeyes had the biggest boost of 6.1%, and then Firehouse Subs, which is really a small portion of total revenues, was up 7%. Now, all four of the brands produced comparable same-store sales growth. Burger King increasing their comparable sales 7.2%. Tim Hortons increasing at 6.8%, Popeyes up 7%, and then Firehouse Subs up 3.4%. So looking at some of the outlook points here. So management expects that they're going to enter 2024 with momentum driven by strong performance of its brands. So continued same-store sales growth, continued expansion of the network of restaurants as well. Now, they did note some near-term challenges. That includes inflation, foreign exchange volatility, as well as rising interest rates. So these are factors that obviously impact most industries right now. Certainly the inflation, the rising interest rates. In a situation like QSR being a very capital intensive business, I would say that it affects them more than most, particularly the wage inflation, because obviously it's a very labor intensive business. But just general inflation across the board. They also have debt on the balance sheet, so rising interest rates have a negative impact. The company plans to continue to invest in growth and reduce their net debt leverage, as well as return capital to shareholders. So $360 million was returned to shareholders in Q3, but they have about $1 billion share repurchase program, which is in place until September 2025. Now, taking a look at that balance sheet, we want to make sure that a company is on a firm financial foundation. So they have net debt of about $13 billion, equity, shareholders' equity of $4.7 billion. So net debt to EBITDA, that's 4.8 times. Pretty high multiple. Now, restaurant businesses tend to have higher net debt to EBITDA leverage ratios. I would say that, QSR's ratio is certainly well at, pushing beyond the top boundary of what we would want to see in terms of a leverage ratio. I will say, however, it is down year over year. So it was 5.2% last year, or 5.2 times last year, rather. So they are trying to push it down, and they've been successful. Debt to equity 3 times, fairly high multiple. And then looking at future growth. So just taking a look at some of the analyst estimates. Analysts are expecting at the midpoint of consensus about 3% earnings per share growth this year, increasing to about 7% next year. So 7% growth next year. And right now the stock is trading in about that 20 times earnings range. So if we look at QSR's 8-year average, it's about 26 times. Certainly it is below the average, but you can't that's not an apples to apples comparison. Growth really isn't that high right now, low to mid single digits. So as well, valuations across the market have been compressed over the last several years, and that has to be factored in as well. And just looking at the company's historic financial performance, revenue growth, it's been fairly consistent with 1 year of decline, which was 2020. So we would expect that. But the revenue growth has been fairly consistent going back over the history of QSR, which goes back to 2015. Earnings per share growth, not nearly as consistent. We've seen a fair bit of fluctuation. Obviously, 2020 was a very bad year for the restaurant industry, for a lot of the restaurant industry anyways. But, even outside of that, we've seen some years of fluctuation. So our take, we love the brands. I mean, it has 4 unparalleled brands, so it's a diversified global company. We like the quick service restaurant space. If you're going to invest in a restaurant company, we're not very attracted to like the mid-range restaurants, sit-down restaurants, but quick service tends to be a little more defensive in a recessionary environment. It is trading at a valuation below its long-term average. It's expanding its restaurant network, their same-store sales growth, and they're also reducing leverage and returning capital to shareholders. However, on the other side, earnings growth has been fairly inconsistent. And in the near term, earnings growth is actually quite meek. I mean, only about 3% growth expected this year. We saw a decline in earnings per share in the last quarter. Certainly, 7%, 6 to 7% next year is more impressive, but they still have to hit that. So when you're looking at the earnings growth, the 20 times PE multiple, the valuation is not especially attractive relative to the growth rate. And then, of course, they're also exposed to inflationary pressures as much or more than most other industries. So we like the company long term. We think it's a very solid business. As a stock, I would say that it's probably fairly valued in the near term, maybe a long-term opportunity, but on a growth to valuation perspective right now, I'd say it's trading, close to where it should be. And who wants to go out and get some Popeyes chicken right now?
I'm hungry.
I like
in.
Burger King. There's
What?
literally down 8th Street, there is a Tim Hortons, a Burger King, and a McDonald's literally a stone throw away from each other. And I used to always gravitate towards the McDonald's. To be honest, I'm now a Burger King guy, kind of. I like their chicken sandwiches.
Brennan is an old soul.
Popeyes
Nobody in the
actually
last
makes
10
best
years
chicken
has said
sandwiches, but there's no Popeyes that's convenient for me, so I almost never eat there. But when my family does eat fast food, we're a Wendy's family.
I like Wendy's too. Yeah.
that. I'm more an A&W because I own shares, full disclosure. So
Nice.
Yeah.
there you go.
Nice.
That's the only reason, right? No.
Like for sales.
Eric, my son, likes Popeyes. He loves it. So
Popeyes,
and there is
I
one
mean,
close.
It's incredible.
Yeah.
I like that it's like crispier than KFC generally. Like it's like more of that like crispy, flaky, as Ryan's laughing.
You're just
at
throwing the Colonel under the bus.
sorry, Colonel.
No.
I threw the Colonel under the bus decades ago.
He's passed away.
Yeah, their fries though. KFC's fries are delicious. Anyways.
McDonald's fries are still probably the best, although they're just off.
Debatable.
I don't think any of it's
That's
really
what we're
that
doing
great.
is debating. All right, let's move on. I think we've beat those restaurants to death. All of them good, not good for you probably. I don't know about the subs. Maybe the subs are better, but I'm not sure. I've never tried the sub brand though there. So, all right, let's get to Dye Durham. This Dye Durham Corporation or Limited, the symbol is DND on the TSX, trades at $10, $542 million market cap. The company is a leading provider of practice management software, data solutions, and payment technology to law firms and businesses. They have about 60,000 clients in Canada, international markets, and they are based in Toronto. Let's look at their first quarter of fiscal 2024. They had revenue that was $120 million. It's basically flat from the prior year. If you take out the impact of a divestiture, the revenues were up a modest 8%. Net income was negative $13.5 million. That's a decrease from last year. Now, if you look at adjusted EBITDA, it was up about 7% to $68.7 million in that quarter. What I'd like to focus on today in terms of looking at this business are the liquidity numbers, the balance sheet of this business. These are likely to improve as EBITDA and free cash flow are projected to improve this year. But we need to consider where the company is right now without projections. And quite frankly, most analyst projections on this company, it's been a buy at many of the brokerage houses in Canada for several years now. Most of them have been off the mark in terms of this company. So let's just look at net debt to EBITDA. It's 7.79 on a trailing basis. That's not so good. Debt to equity is in the range of 3. Free cash flow to debt is around 0.10. Now, put that in context. Now, it kind of depends on the industry, but a healthy ratio would generally fall between 1 and 2. So 0.1 is not great. It also has a working capital deficit. So current assets are 127 million. Current liabilities are 150 million. The company also, in its infinite wisdom, with these significant debt levels, and they do have a priority finally to pay back debt, they've instituted a dividend. Now, the yield is under 1%. It just really seems disjointed from the reality of where the business is right now. From a valuation basis, on a trailing EV to EBITDA, it's about 11.2. I have seen estimates for significant EBITDA growth on this business. Again, analysts have been wrong before, so we'll take those with a grain of salt. On the forward estimates right now, it's EV to EBITDA is in the range of 7.5. That kind of looks more attractive, but I'll give you our take. Dye Durham is a business that grew revenues year over year at 7% this past year, and the last quarter was flat. You kind of take out that sale of part of the business, and it was maybe up 7%, that 7 to 8 in that range. Growth has basically all come from acquisitions, which has been the playbook for this company. The playbook, the capital structure, and the overall decision-making by management is really something to question for this business from my perspective. They had also a massive takeover, almost larger than their business, trying to take over a business that failed over the past 2 years. So that's kind of would have crippled an already stretched balance sheet. It is no wonder when you look at the share price that the stock has been crushed in the market. D&D unveiled a business improvement plan to drive free cash flow in their recent Q1 on their call, and they signaled that deleveraging is key to capital, or is a key capital allocation priority. The company announced a business improvement plan that aims at driving about 70 million in annual free cash flow, incremental free cash flow when compared to Q1 2024, the levels they just reported. Key drivers that will add to free cash flow include lower capital expenditures. They're talking about 20 million savings there. M&A and restructuring costs, savings about 10 to 15 million. Ongoing price increases, they're looking for 10% targeted per year, and a modest reduction in overall operating expenses. Now, all of these initiatives sound good, but one must question a company that had to stretch its balance sheet so far in terms of debt, get hammered by the market, and then finally, just now decide to start to focus on cash flow generation and rein in spending. So the stock trades at around, like I said, 7 times EV to EBITDA, 7.5. Forward looking, there is limited growth from the core business in the last quarter. I would question where the growth is going to come from going forward. Management, again, as stated, rightly so, the company's priority is to pay down debt. The team has kind of painted itself into a corner here. High debt, low core growth, high interest rate payments. It will be tough to grow via acquisition, and it's a long road to pay down the debt. The company appears to me to be dead money in the near term. Perhaps the cost cutting will bear fruit. Perhaps D&D will be bought out at some point, but I would not, if I was an acquirer, look to take on that debt at these levels. We would not invest in a business based on that possibility alone that it could be a takeover target. Now, we've been asked about D&D many times in the past and continue to pass on the business. Like I said, from 50 to 40, when it went to 30 to 20, and now it's at 10. The valuations may look better, but the company will be challenged to grow its top line. And we see better software-related companies with cash-rich balance sheets in Canada that can, at present, go on offense in a downturn and not play defense as D&D is today. Despite the drop in the share price, I would still be a pass on this company right now.
Yeah, it's very rare that we're going to, look at a company that has had such a decline in the market. I mean, typically a decline like that comes with a good reason. Not always, but, in the vast majority of cases. So this is a company that we've looked at many times. We've had, as Ryan said, many questions on it. But, some people will say, well, what price then does it become a good buy? I mean, I would say for us, there's not really any price because we're looking for a company that just has more of a
there is
fundamental strength, and then we look at prices.
I mean, there is some free cash flow growth, which starts to be a little bit attractive, but we'd like to see the growth come with some revenue growth as well. And there really doesn't, the core revenue growth, other than price increases, they're looking at maybe 10% price increases, which is fine. But do you have growth in that core business? Software management software for the legal industry seems like it should be relatively sticky. Seems like a good business, but the way they went about putting together this company, making acquisitions, and just leveraging up the balance sheet, you get this situation where now they're just in a holding pattern where they have to pay off debt, bring it down. Now debt is becoming more costly. So all of these things squeezing cash flow too, and they're trying to pay down debt with that cash flow. Perhaps slow down and be a slow consolidator over time. Don't try to do it all at once. And if we look at the time that this company was making its acquisitions at one of the priciest times to be doing that in the market, and you've levered up your balance sheet, it's going to be a kind of catch-22 whether or not pay down debt. And I think they're eyeing like an EV to EBITDA or a debt to EBITDA ratio of 4 when then they can start then making acquisitions. And like you're starting with 4, and then what are you going to go to 5? Then you're too much in debt. I mean, even 4 for us, maybe in a sticky SaaS related business, you could sort of justify it, but you can't go much more into debt, right? So, it's going to be quite the journey here for them to pay down debt and then maybe try to grow by acquisition again. Perhaps they can cross-sell in their business. Perhaps they can grow their software business organically, but it's not there right now. They're talking about price increases being a growth, which isn't just adding new customers. It's fine. You can increase prices to existing customers, but I'd like to see more organic growth, better free cash flow, and then obviously they need to pay down debt. And you may just see at some point an equity financing, and I believe they recently had one again, so that you could have that type of dilution. They have been buying back shares, but it's like, okay, buy back shares, we got to pay back debt. There are other businesses out there. This is what we're trying to get to. We talked about one last week, a Canadian software business in Canada that has 250 million in cash in the bank rather than $1 billion in debt. And this is a time when capital is hard to come by. They can use that capital to buy businesses that come on sale and need capital. And I'd rather be in that situation. Plus, the two businesses that I'm talking about here trade on an EV to EBITDA basis, relatively similar valuations. So I'll take the business that has cash in the bank versus the business that is heavily indebted. All right. I think it was Brett next because we know who's last, right? So
And leave.
No, that's horrible.
Just picking
Brett,
on Brennan today.
You got a question on TCL.A.
Yeah,
correct?
TCL. So, like Ryan was saying, Transcontinental Limited, symbol TCL.A on the TSX. They have two classes share, but the A class is the primary class. It is a leader in flexible packaging in the United States, Canada, and Latin America, as well as Canada's largest printer for items like books, magazines, and newspapers, amongst other items. Revenue is roughly split 50-50 between the two groups at this time. The stock is currently trading at about $11 a share with a market cap of 950 million Canadian. The shares, however, are down 28% year to date, and as well, it pays a dividend yield of 8.2%. So, looking at the last quarter, revenues came in at 707 million, which is down 5.5% year over year. Adjusted operating earnings before depreciation and amortization came in at 108 million, down 4.5%. Similarly, adjusted net earnings fell 10.5% to 51 cents per share. So a top to bottom decrease. As revenue came down, so did the bottom line. Management attributes the drops to customers destocking for packaging. So as we saw for many industries, when the supply chain was really limited during the pandemic, they all bought up, and now they have an overflow of stock. And now you have those companies needing to go work through that stock before they buy more. As well, Transcontinental is seeing a weaker economic backdrop, lowering volumes for both their packaging and printing segments. With cost-saving measures in the printing division, they partially offset the decrease. But if we step back looking at a 10-year graph of their revenue, growth has just not been the company's strong suit. The company has had relatively flat earnings, barring the jump in 2018, which was attributed to a big acquisition of Coveris Americas, which added flexible packaging to the company, but has failed to see growth since. And with the drop during the pandemic, we're now seeing year-over-year declines after that. The printing industry is obviously a mature industry, so a decline in overall is not exactly a surprise to see no organic growth, or recently, in their case, a decline. Now, shifting to the balance sheet, the company has a net debt and lease position of $1.1 billion with a trailing adjusted EBITDA of $442 million. Roughly, the leverage is 2.5 times. Of the company's $1 billion in long-term debt, $464 million is at a variable rate, or $310 million after you account for their swaps. So as interest rates have rose, their variable debt has put downward pressure on the company's bottom lines as interest rates have rose. That being said, Transcontinental have continued to have a positive operating cash flows, which is always a good thing to see. That strong earnings quality when you're seeing it actually come through on cash. Over the past 9 months, the company has generated $226 million in cash from operations. However, once you consider the CapEx and the mergers and acquisitions from its shifts into more packaging and payments of interest on debt, and then their dividend as well, there's no additional cash left over. So they're not building the cash balance sheet. Whatever they take in, they're putting out as well. Dividend has not actually grown as well. They stopped growing their dividend in 2020. They're quite consistently growing it for over a decade prior to that, and now it's just sitting at 23 cents a quarter. So it's no longer being that dividend growth story. It's just a flat dividend. So moving to valuation, the company has a trailing adjusted earnings per share of $1.99, resulting in a trailing PE of roughly 5.6 times. However, looking forward, given the weakness which management is expecting, Q4, which is normally a stronger quarter, the earnings for 2023 will likely be lower, resulting in ultimately a higher valuation, probably in the 6 to 7 range, compared to the 5.6 which we're seeing on a trailing basis. So our take, the company is unlikely to have really any sustained growth given its industry at this time, as well as the near-term weakness due to macroeconomic environment. It is just putting additional pressure on the company's operations. Transcontinental is impacted due to higher interest rates really in 2 ways: the increase in interest expense for its variable debt, as well as if interest rates stay high and until it needs to refinance, then they would their fixed securities, then they obviously need to pay a higher interest rate. As well, the companies do see downward pressure in its share price as investors have moved from these mature, high interest paying or high dividend paying companies to just interest bearing securities. So you go from your 8% Transcontinental to a, let's say, 5% bond. You're taking off a bit of risk, but it's much more secure when you're lending to the government versus having an equity position in a company and in a mature industry. So overall, the company is likely nearest fair term value given the lack of growth in the current macro backdrop, as well as it needing long term. It needs to keep doing those M&As to even retain its growth or retain its revenue line right now. And over time, it may trickle into some sort of growth, but we're not really seeing that at this time. So really just a fair value stock, I see it.
Yeah. I mean, it's Transcontinental. That's another company we're very familiar with. And it's traded at a depressed valuation for several years going back, which, as you said, a significant portion of its business is in decline. So there are some companies out there where they have, half of the business in decline, half the business is more of a growth area long term, and they're transitioning over slowly. I think that, over time that has the likelihood of working, but this is what I would call probably a deep value play right now. So it's not something that you can expect to work out in the next 6 to even 12 months.
Yeah, I'd say 5+ years for them with how long the transition is going to take.
5+ years. And then even on the packaging side, packaging businesses are also under pressure right now just because so much customer inventory was built up last year. So that's impacting sales and margins.
Yeah, we've looked at a few smaller packaging companies this year, and the most recent quarters have typically showed declines, and then they're actually forecasting lower demand in the near term. So you're hit by a couple things there. Finally, we're going to look at last but not least, Brennan, and
You said that wrong.
you've got Cameco Corporation.
This
True?
is correct.
Uranium.
Uranium.
Brennan's a huge uranium supporter, so that's why
they're
he's
based out of
taking-
Saskatoon, so
That's what I mean. Mainly,
yes.
it's geographic. His
yeah.
support.
So yes, this question came in from Rex via email, and he said, or generally he didn't say this, but the stock has done quite well over the last year, up about 74%, and it's up 280% over the past 5 years. But we'll look at the long term as well. So Cameco CCO on the TSX currently trading at a price of around $56 and about a $24 billion market cap, and a dividend yield of just 0.2%, and it's an annual dividend frequency. You don't see that too often. So Cameco is a pure play uranium producer headquartered, like I said, in my hometown of Saskatoon, Saskatchewan. The company has two segments, which include its uranium, which is 85% of sales in the most recent quarter, which includes exploration, mining, milling, and sale of uranium, as well as fuel services, which is 15% of sales in the most recent quarter. And this involves the refining, conversion, and fabrication of uranium concentrate and sale of conversion services. So Cameco has mines in northern Saskatchewan and the United States, as well as a 40% interest in the Inca JV with Kazatomprom, which is majority owned by the Kazakh government, of course, in Kazakhstan. Now, other than the JV in Kazakhstan, only two of Cameco's mines are operating, which are the Cigar Lake and MacArthur River. Now, operations at the MacArthur River and Key Lake had been suspended in 2018 due to deteriorating market conditions, but management resumed them in November of 2022. Now, the Rabbit Lake operation in Saskatchewan was placed on care and maintenance in 2016, which it remains on. And Cameco's operations in the United States include Crow Butte and Smith Ranch Highland. But again, both are not currently producing, as the decision was also made in 2016 to curtail production. And as I said, its second segment is fuel services, which supplies much of the world's reactor fleet with the fuel to generate electricity. And these facilities are within Ontario. So over the long term, revenue and earnings have been on a declining trend due to the persistent decline in the price of uranium, which led the company to place several of its mines on care and maintenance in 2016 and 2018 to curtail supply and help the weak market conditions recover. And since then, the price of uranium has been on a recovery, and as such, so has Cameco's stock price. And I actually include, there's a little graph here if you're watching on YouTube, the price or the spot price of uranium. Now, looking at the last quarter, Q3 of 2023, reported in October, revenue was up 48% year over year to $575 million. Net income was up to $148 million compared to a loss last year, and earnings per share was 34 cents compared to a loss of 5 cents for Q3 of 2022. Now, the balance sheet is healthy currently with about $2.7 billion in cash, just under $1 billion just under $1 billion in debt, and net cash of about $1.7 billion. Now, right now, the business trades with a trailing PE of about 90 times and about 45 times trailing price to cash flow. But of course, these are elevated due to the recent run in Cameco's stock price and given the increase in price of uranium, which higher prices will be realized over the next few quarters, assuming that, the price of uranium sticks around here compared to the trailing results. So, in theory, the forward multiple should be more reasonable, but we just do not know how much more reasonable, of course. And if we annualize the last quarter, the price to earnings multiple would be closer to about 40 times. Now, at the end of the day, though, the price of Cameco will go where the price of uranium goes, as shown by my overlay chart here, with Cameco stock in the blue and uranium futures price in the orange line. So as you can see here, if uranium does well, Cameco stock will do well, and vice versa, of course. Now, just to finish up here, management said on the durability and demand, the durability of demand and supply. Climate change targets need nuclear to achieve net zero. Policymakers are embracing nuclear, which they said that they haven't really ever seen before at this pace. Now, Asia's nuclear expansion is beginning to move beyond the region into Europe and America. And energy security is also driving growth, of course, with kind of the geopolitical tensions that we're seeing around the world and just the need for countries and energy security in general. And the CEO made the comment that demand for nuclear power is driving the best fundamentals we have ever seen for the nuclear fuel market. And I thought that I'd also bring this up, the acquisition of Westinghouse Electric for $7.9 billion with Brookfield Renewable, where Cameco will own 49% and Brookfield will own 51%. The acquisition was announced a year ago in October of 2022, and it just received approval from regulators last week and is expected to close this week. Now, Cameco will finance its share of the acquisition with $600 million in its term loan available, as well as available cash. So once this closes, Cameco's balance sheet should change significantly. But it is an interesting acquisition as it provides more nuclear capabilities to the company, including energy system and reactor technologies, engineering and manufacturing, and more. But to conclude here, personally, I like the long-term trend of uranium and its importance to combat climate change and ensure countries with energy security. But over the next decade, I have no idea if this will translate into a positive stock performance. Now, it appears that there are some tailwinds for the sector. But again, at the end of the day, the stock is tied to the price of uranium, and its balance sheet is about to change drastically following the closing of the Westinghouse Electric acquisition. And we cannot forget that from 2004 to 2020, Cameco was not a great investment, driven by very weak market conditions. So if someone thinks the price of uranium will continue to perform well over the long term, you could consider Cameco, but I believe that it, is generally speculative just based on the commodity itself. But if you wanted to take a position, just because of, your thesis on the price of uranium, you could. It's speculative. Make sure that if you did take a position, it's a small piece of your portfolio. You definitely wouldn't want to take a large, 5% or even 2.5% of your portfolio. I think that, hedging the position size would help mitigate that risk. But, it's definitely not one that I'm adding to my portfolio at this time. And I'll open it up to the gentleman.
Yeah, I mean, you sum it up with many commodity-based businesses. It so goes the price of the commodity, so goes uranium, so will go Cameco. So if uranium stays in its current range, does well this year, Cameco follows suit. If uranium's down 30% next year, Cameco's shares likely, are going to be. It's going to be tough to see them perform very well in the year. So,
yeah, and
if you want exposure to uranium, this is a company, a leading company in the sector. There is some exposure right there. It's going to be volatile with the price of uranium.
Yeah, and even just looking at
I'll just say that I'm actually impressed with how closely it follows the price of uranium, because we've done work
crazy, right?
Yeah.
On gold mining stocks, and they typically don't follow the price of gold that well, but it's to the detriment of somebody who wants to have exposure to gold. So it is actually a good investment for exposure to uranium if that is what you're trying to do.
Yeah. And just reading in the conference call, they're talking about, oh, this cycle is different. This one, has all these factors behind it. But, we hear that, many times.
They're always different. I mean, I've heard that just about uranium several times in my investing career. And it's,
you hear the super cycle and whatnot all the time.
I mean, I will say that, we've done work with our electrification report, and I was looking at, I was tasked with the job of looking at renewable power producers and getting together some research on that. And, the forecasts are that 90% of new electrical generation will, over the next 5 years, I believe it is, be from non-carbon sources. But a big chunk of that was nuclear, actually. So not just renewable.
Yeah, and to me, if it can be done, more safely over time, find unique ways to dispose of waste, it makes sense. But
there's actually
where the price of uranium goes this year or next year, we're launching it into space. Are you?
No, I recently watched a couple episodes of this series called Chernobyl on HBO, and I mean, obviously a completely different situation, but it's pretty scary when things go wrong.
Yes, it is.
Yeah.
All right, I think that's going to end our show this week. I encourage you to keep your questions coming into our Your Stock, Our Take segment. Get your tickets, again, to our final DIY webinar of the year this Thursday. That is the 9th, right, Brennan?
Correct.
Look at your calendar and you'll find... There we go.
It's the 9th.
Yes, it's this Thursday, the 9th. Would love to see any and all of you there. Keep those questions coming in. If you're watching us right now on YouTube, smash that subscribe button. If you're listening on iTunes, remember to rate and review us. Only positive reviews. And as always, I wish you profitable investing. Thank you.
All right, thank you.
Thanks, everyone.
Thank you.